Hello, 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 and welcome. This is Art Veal, and welcome to another episode of the Can I Own podcast. In this podcast, I discuss some of the questions and situations that people find themselves in when they are trying to purchase a home, or they are maybe they've lost a home and they're trying to get into a new home. And we just answer some of the questions and concerns that come up in hopes that it will help someone else out there that may have a similar issue. Today I'm going to be answering questions that have come in over email or through Twitter or directly to our program, the Can I Own program. Today's first question is from Matt, and Matt is asking, should he buy a home with a down payment that comes from a loan from his family? So what Matt is saying, let me look through this. He's saying that his father has agreed to give him a loan in order to cover the down payment on his home. And he has to pay the loan back over the next 3 years. And Matt makes money. He has a job and he has income, but he does not have the 20% down that he believes that he will need to buy a home. And his father is willing to loan him that money. And should he do that as a loan? Well, that's a great question. A lot of people have this issue come up when they're looking to buy a home and they have family or relatives that want, their parents a lot of times want to help them out and help them get into the home quickly, so they'll loan them the down payment so they can come up with it. Now, there are a few caveats that go along with doing something like this, and the first is how you get the money. Banks typically do not like for you to borrow the down payment. If you remember, the whole purpose of a down payment is so that you have some skin in the game, so that you've got something invested into this house that you're buying, so that so that if things go south and you have problems, you don't just walk away and you really have nothing into the property. So banks want you to use your own money. However, banks are okay with you getting money as a gift from family up to a certain. There are some stipulations that go with that, but they're okay with you getting money as a gift, or they're okay with you raising money through some other techniques, some fundraising techniques. But if you go to your bank or your lender and tell them that you've gotten a loan from family or anyone for that matter for your down payment, that's going to be a major red flag. So the way to do this, if you want to still borrow the money from your father, is to have your father write a letter saying that the money is a gift, and he would need to write a letter and have it notarized showing that the money is a gift to you. And then when you submit your loan application and all your documentation, you would show them that letter that says the money is a gift. Now, I know that you said, Matt, that the money is not a gift. It's actually a loan. And so this is a way around the lender's requirements. A way to not raise a red flag with the lender because it's a loan. But in doing it this way, you have to be diligent on your side, and you need to make sure you calculate out your numbers very well. You need to calculate out how much you're going to be paying for mortgage payment and insurance and taxes, along with this payment that you're making back to your father, and make sure you make terms that make sense for you. You don't want to just rush to take this loan, and the terms don't really make good sense for you. Another way that I would probably do it instead of doing this loan is talk to your father about possibly gifting you some of the money, maybe matching the money that you can save yourself. That's a much better way to do it. Say, if I save $5,000 on my end, can you gift me $5,000 as opposed to loaning it? Your father would respect that. I'm assuming your father might respect that because of the fact that you're showing that you're willing to put some of your money into it. And at the same time, he can still help you out. And a lot of times parents want to help out their children, so there's nothing wrong with that. But you just don't want to get in over your head and end up borrowing more money than you really should from your father or the bank. So that's how to deal with money from a family member. But again, I would try to look at it as a gift. Okay, so the last part of this that I do want to bring up is that if you're looking at an FHA loan, then the FHA does have very strict requirements for money that is gifted to you in exchange for a down payment. So be sure to talk to your lender and be honest with your lender about what you're doing. Tell them that your parent or family member is gifting you the money, or you can say borrowing the money, but I'm sure they're going to tell you that you cannot borrow the money. So you need to focus more on gifting than borrowing. If you do borrow, like I said, you'd have to do it under the radar, which I don't really advise. But make sure you tell your lender, and they'll give you the requirements that your particular lender, FHA or whoever you're getting your loan through, has when it comes to money that is gifted to you. So that's our question for today. I'm also going to go over another quick question that came up just because someone asked, and I want to touch on that. And the other question is, should I wait until I have a 20% down payment to buy a home? This was Fran asked this question. She has money that to put down on a house. She roughly has a couple of $1,000s to put down on a house, and she's wondering, should she wait to try to buy a house until she has a total of 20% down? The short answer for this is no. I typically don't think it's necessary to save 20% down to buy a home. It is necessary to save as much as possible when buying a home, because lenders like to see not only that you have the money for the down payment, but they also like to see that you have additional money so that you're not going to give your last dime to this down payment. You're going to need the money for the down payment. You're going to need money for closing costs, and you're going to need money for incidentals. Plus, they like to see a little bit of money in addition to all of that money. So let's say, for example, you're buying a $100,000 house. Your down payment is 5% down, which is $5,000. You're probably going to have 2.5% in closing costs, which will bring you up to $7,500. And then they'd like to see you with, let's say, $10,000 to $11,000 total. So you have $2,000 or $3,000 still in savings after you pay for the down payment and closing cost. So you definitely don't have to wait for 20% down. If you can't go with an FHA or a government-backed loan or a Fannie Mae, something that's a government-backed loan, then you typically do have to come up with more money down. But most of the loan programs, unless you're doing a really large loan or something extreme or something maybe that's out of your price range, most programs you can get by with about 10% down. And if you don't have that 10%, there's ways to even get around coming up with 10% down. If you go FHA, you can come up with as little as 3%. And with some of the programs that we discuss and go over in the CanIOwn program, the 6 Steps to Home program, we show you how to use all kinds of different programs to offset even that amount of money. So it's very common for people that work with the CanIOwn and the 6 Steps to Home to come up with almost nothing down or very little down if you set up your loans correctly and you set up the programs that you work with correctly. So by no means do you have to wait for 20% down. There's, like I said, plenty of opportunity to buy a house with much less money down. However, if you do have that amount of money, 20% down, you can qualify for loans much faster. When you have a large down payment, 20%, 15%, something like that, most lenders will allow you to have a lower credit score. Most lenders will allow you to have lower, for example, if your job history isn't that long, but you have good money for down payment, they'll allow you to slide on something else. It's kind of a balance where they're looking at three things. They're looking at your income, they're looking at your down payment or savings, and they're looking at your credit. If you've got more of one, if you've got really great credit but a low down payment, then lenders will work with you. If you've got really high down payment money but low credit and low income, then they'll still probably try to find a program that works with you. If you've got no income but you've got credit and a down payment, that might still stop you, because you have to show some kind of income, or at least show where you're going to get the money to make this payment over time. So you have to kind of have some kind of income. Usually with income, it's not so much if you have income. They're more looking at your job history, how long you've been on your job, and that your income can support the monthly payment that's going to be required for your house. So I hope that helps you for this week. That's been our 2 questions that I've tackled that have come in. If you've got a question about buying a home with no credit or no down payment, or if you've got a question about how to quickly save for a down payment, or anything under the sun when it comes to buying a house, I'd be more than happy to answer it. This has been Art Veal again with the Can I Own podcast. Until next time, I wish you luck. I wish you to be blessed, and I'll look forward to seeing you next time. Thanks a lot. Have a good one.